Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
We have the Taiwan index that's shut, but Hang Seng that's trading with cuts of more than 1%.
It is higher than the old series, which was expected to come in at 2.3%.
Sharp corrections, and this is not, a small 2-3% kind of pullback.
In principle, that message is clear. It is real. This disruption is here. Like you said, it is on our doorstep.
Stellar set coming in for Honasa. A 16% revenue growth.
It's another 1% cut, near 1% cut, 25,600.
I think gold and gold-related companies have seen a tremendous amount of value growth-driven growth.
It is incumbent upon us to, definitely evaluate every opportunity that comes our way.
I think as the price increases or the LTV goes up, the tonnage has to come down.
All in all, we see the demand outpacing supply.
I think you have a tight supply-demand situation. And then when you look at the investor sentiment, commodities are now very much in favor.
Right now, the Nifty is below that 25,600 mark as well.
At the session low today, the Nifty IT index had seen a fall of 11.7%, and that would have meant the steepest weekly decline in 6 years.
It's been a down day for the markets, and for the IT index, it's lost around 8% on a week-to-date basis as well.
Well, that is the day so far. It's another tough day, 270 points off on the index. IT stocks, of course, the culprit, but I have to say, smart recovery as well from the day's lowest point. The IT index was down 5% in the morning. I think it's down about 1.5% the last I checked. This is Closing Bell. We're coming to you live from the CNBC-TV18 Muthoot Finance studios. I'm Prashant. Nigel and Rima with me. Guys, afternoon.
Hi, afternoon. IT has recovered about 4.5% from the lows, but the sentiment in the broader market is hit. The mid-cap index, small-cap index, even the advanced decline ratio, 2,200 stocks in the red, Nigel.
Well, Rima, the tech stocks actually good recovery. It appears someone is going in there for a longer-term horizon. Otherwise, it's just being sold into on a day-to-day basis. Today, at least, there's actually a 3% recovery from the lows. And yes, Rima, I take your point with regard to the advanced decline ratio, but it appears both those two lines actually have at least got a little closer to each other than what we saw at the start. It was only 300 stocks that are advancing. That number's moved to around 710 odd, far away from kissing each other. But, it's 1:3 now. In the morning, I think it was 1:6.
And there's no sector which is in the green right now. So it's not that the sell-off is just an account. Sell-off is just on account of IT. Even the metal index is down 2.5%. The realty index is sold off 2%. CPSC 1.8%. FMCG 1.5%. So it's a fairly broad-based selling pressure. Can't pin the blame only on tech.
Can't pin the sort of blame on tech. By the way, Nigel had a sly smile on his face. Nigel will tell us later through the course of the day.
No, it's case day. I mean, the bulls would want both those two to come closer towards each other. The advanced decline ratio far away, but let's focus on the market.
But red color for Valentine's.
Yeah. As they say in Hindi, mein dil behlane ke liye. Otherwise, aur kya? Well, let's take a quick look at what's coming up here, right, in terms of interactions, etc. So, selling pressure, of course. Nifty, tech counters are weak, but off the lows by quite a bit. Broader markets is something we'll talk about. India Wix is up about 9%. Muthoot Finance spoke with us earlier today. Numbers are strong. Guidance has been up. Stock still down about 11.5%. We'll play out those sound bites as well. Hindalco reported largely in-line set of numbers. More details, fine print coming up there. EIL, the last I checked, was up over 10%. Honasa is up in a weak market. So, some of these smaller earnings also will find their place over the next 60 minutes as we wrap things up. Mitesh is with us with what he'd want you to do as far as specific trades go. Mitesh, good afternoon. Good to have you here. Going into a weekend, it's been just an absolute tsunami of news flow. Over the last 5, 6, actually last 10 days now, right? But what would you do? What would you want to tell viewers to do in terms of index and then stocks?
Good afternoon, Prashant. In the afternoon, I was saying that, we'll look for, in the morning, I was saying that we'll look for some reversal around this 25,600, 550 zone and then take a long, which has not happened. So fortunately, I think, there has been no false bounce back, which could be trapping the bull side trade. So that's a positive. I think on the stock side, with the markets now trading below this 25, 550, 600 zones, I think one, cut down on your long exposure, exit if possible, if it's not too much of a loss, or if you have some profits there as well. I think that's a good strategy. And wait for 25, 600, 650 to be captured before thinking of going long again in the short term. So I think the idea is that the bias is turned slightly on the negative side with today's price action kind of confirming a minor breakdown. And that's why the position should be like that. On the stock side, I think Prestige Estate is breaking down on the hourly chart. So we'll take a slight negative call here. Keep a stop at 1550. Look for targets of around 1455 to about 1450 on the downside. And SBI Life is still, showing some positive traction, some strength on the chart. So that's on the long side, a trade with a stop at about 2018 for targets of 2070.
Okay. Just on IT, there was an interesting note which came out from JP Morgan. It was just all sell, sell, sell for the last few days. Now, JP Morgan says that the free cash flow to dividend yield are now screaming deep value. And they're reaching levels or crossing levels which were last seen during the GFC and COVID. So severe market dislocation. They're arguing for valuations being at ultra low levels. Now, they've also done some scenario analysis. What can cause a further 10% downside from here on? They're saying that in the last 3 years, we've seen a revenue growth of 2 to 3%. If we assume that is going to be the terminal growth rate, that IT industry continues to see this low single-digit revenue growth, then there is a case for a further 10% downside. But if you assume that there is going to be some recovery in the earnings growth, not at the current 2 to 3% that it's seen for the last 3 years, not at the long-term average of 7-8%, but somewhere in the middle, a mid-single-digit kind of a revenue growth, then stocks stay where they are. But what is a deep, bear case if you assume absolutely no growth, which is for the next many years, IT industry top line remains where it is, zero growth, terminal growth. Then there is a downside case of about 30%. But in a nutshell, I think they are saying that valuations perhaps the sell-off got a bit overdone, and valuations, when you look at it on a free cash flow to dividend yield, are looking fairly attractive, and that maybe explains that that 4.5% recovery that we're seeing from the lows on the Nifty IT index. Maybe the pessimism got too much. But let's also talk about Muthoot Finance, that's trading with cuts of about 10% despite good numbers and the company raising the guidance. Gaurav now joins in. So Gaurav, the company told us that the AUM growth guidance stands at 45%. Earlier it was 30 to 35%, yet the stock hasn't recovered.
Well, if we look at Muthoot Finance and the numbers, let's revisit the numbers first. First, we saw profit increasing almost by 95%, and this was aided by the NPA recoveries worth 960 crores that the company recorded in this quarter. Apart from that, what it translates as the ratios. Now, net interest margins that increase almost by 11 basis points, and we have got a company which is delivering the ROEs in the tune of 30% now. At the same time, even if you look at the AUM growth, there was no disappointment here at all, because gold AUM that grew almost by 50%. In fact, the Belstar, which is their MFI arm, also showed some kind of recovery in the AUM growth. On a sequential basis, it grew almost by 2.5%. But still, if you look at the market, it is not appreciating the fact that the result was good. And there are three key reasons that we have highlighted. First is that if you look at the gold AUM, although they have increased the guidance from 30 to 35% to 45%, let's not forget that in 9-month FY26 so far, they have already achieved that 35% mark that they were guiding for in FY26. So the revision in guidance, that was mostly warranted for by the market. Second is that if you look at the AUM growth, now that remains strong, but at the same time, there are two concerns. First is that the tonnage growth, that has remained flat on a sequential basis. And second is the number of customers. They have also remained flattish on a sequential basis. Management did not show any kind of concern on these factors, but these were some of the points raised by investors. Third, if you look at the valuation, now even after the fall, it trades at 3.9 times price to book. If you compare it with its closest peer, which is Manappuram, it trades at just 1.7, and IIFL Finance, which is again one of the gold financiers, it trades at 1.4 times price to book. So there is a huge gap of valuation between all these companies and Manappuram Finance, which actually also results in some of the fall in that we are seeing right now. So all in all, numbers were not bad, but the pessimism that was built in because of the numbers coming ahead and at the same time some profit booking is the reason why we are seeing some fall in Muthoot Finance today.
Okay, all right. Thanks a lot for that, Gaurav. In fact, we spoke earlier today to Mr. George Alexander Muthoot, the MD of Muthoot Finance, where he hiked the guidance for the loan, gold loan AUM to 45%. He also commented on the lower tonnage and the LTV in the quarter gone by. Let's hear out what he had to say.
This quarter, the first 3 quarters have been good growth. We have seen in the last 3-4 quarters have been quite good. We have already grown the gold loan AUM by 36%. I feel that we should be able to do around 45% by the end of the year. We should reach that by 45% by end of the year. So that is, I think, something which we plan to achieve by the end of the year. So the LTV goes up, the tonnage has to come down. Having said that, today, if you look at the price of gold today and the amount lent by us, the LTV is only 57%. So there is always headroom, more money to be given, but people take money only what they really need. So the tonnage is dependent on the gold price. Incremental people generally take about 69 to 70% average. Today, if I give, some people take 75, some people take 60, some people take 65. On an average, today's price, the LTV would be maybe 69 to 70%. That's all.
Okay, on Belstar, he said things are improving, but as of now, no IPO plans because Belstar does not need any sort of capital. They will tap the markets only when they need the capital, but there has been an improvement in the profitability. But the growth from here on is going to be cautious and not aggressive. Mehraboon Irani, market expert, is now joining in on the show. Mehraboon, you want to comment on Muthoot Finance, 12% down?
Well, I have been a bull as far as Muthoot goes for the last at least 7 years. And to those people who look at the results with some doubt, saying that there are some write-backs and client growth has not picked up much, my answer to them would be that, except the fact that the stock has doubled in the last 12 months, and there is definitely a reason for the stock to correct. So from 4,000 odd coming to 3,600 is no big deal for a stock which has gone up from 1,800 odd rupees to around 4,000 rupees in the last 12 months. Let's accept the fact that Muthoot Finance is fundamentally strong, solid growth prospects, and I think it would be a great core NBFC stock, even around 34, 35, 3,600, where it could move in a narrow range for some time to come. I think it would be a great core NBFC stock for investors at this present price. The price to book value at 3.5 to 3.7 at the present price honestly is not expensive. Even if you look at the PE ratio, which is not the right way to look at a company with Muthoot, which is keeping on growing at around 20 times, is also not very expensive. It remains fundamentally strong. It is a market leader. Comparing it with Manappuram and IIFL would not be a fair thing to do because Manappuram is in one or two other businesses where it is facing the pressure. The profit growth was good. The management guidance is good. No complaints at all. The complaint is that the stock had gone up too sharply and people questioning it, saying that, oh, it has become expensive and all. It's post-mortem people are doing. The fact is the stock needed to correct a little bit. And I think they have found out a reason by pointing out some write-backs and not too much of growth in the number of clients, and sequentially there's not too much of improvement in margins. But we have reached a level at this particular scale. I think such type of things could happen off and on, except the fact that there is no problem as far as debt recovery goes. So this is the company we should continue to do well. I'm quite comfortable holding on to it. Clear disclosure, I'm holding it and I have no intention to sell it. And if you give me another 10% lower, possibly I'll go and add to my holdings.
Got it. Okay. All right, Mehraboon, taken that point. Let's focus on another big loser, which is Hindalco. And let's explain this to you. Reports suggest that President Donald Trump has planned to scale back some of the US tariffs on steel as well as on aluminium goods. These are unconfirmed reports. Remember that Mr. Trump had doubled the import tariffs on steel as well as aluminium to around 50% in somewhere around June last year. So let's do a quick analysis. What could this mean if these tariffs actually are lowered? It could be sentimentally positive for global steel as well as the aluminium industry because that fear of demand destruction, that will go away. That's a sentiment positive. But overall, it will be neutral for most of the steel as well as aluminium names, assuming that this reduction in tariff is universal and it's not country specific. So we'll have to keep an eye out on that. Hindalco, that one could have a bit of a problem. As Novelis, well, it will get impacted by the reduction in tariff rates, which could in turn lead to lower US aluminium Midwest premium. That has doubled, remember, in the last 6 to around 8 months. And that has hit an all-time high of around $2,250 per ton levels. And assuming it would hold at current levels, actually the tariff impact which has pushed up this Midwest premium would have been beneficial for Novelis. So if the Midwest premium comes down, it could probably have an adverse impact on scrap spread, which in turn will hit Novelis' profitability. In fact, I spoke to Hindalco management earlier today, Mr. Satish Pai, and he said that with the Midwest premium at around $2,200 per ton, the negative impact of the higher tariffs, which has been plaguing them over the last few quarters, that is behind them. So they were bracing actually for better times if the Midwest premium holds at current levels. And now if Mr. Trump pulls back on these tariffs, it could be actually a negative because the Midwest premium will come down. That in turn would hurt Hindalco, that is Novelis' profitability. What's your view, Meribun? The stock had a one-way run. It's underperforming today because of this fear that the tariffs get pulled back, Midwest premium comes down. If I got the number correct, I think in June last year it was around $800 to around $900. That number has gone dancing away to around $2,200 per ton. And if that comes down, it'll hurt the spreads. Your view on Hindalco?
I think there have been disruptions also as far as production goes at Novelis.
That's true.
Two accidents happened. And now Hindalco is planning to put in more capital over there. So it can affect the cash flow of Hindalco, which is another negative. And the tariffs part also could turn out to be a little bit negative. But personally, if you ask me, I think, and I know you track commodities very closely, Nigel, and I really respect you for that because you were perfect and accurate always. Let me also state something that my personal view is that some of the commodity stocks, where I will include Hindalco at a particular price someday, I think some of the commodity stocks will be market leaders in the next 3 years. That's my personal feeling. So Hindalco, I won't be very, very negative. Again, for Hindalco, I would say this is a stock which has gone up by 50 to 60% over the last 12 months. It's corrected today for the right reasons, but let's understand the Indian operations. Indian operations, record high, the profit-wise. Novelis took a big hit because of the accidents. Company is planning to put in money. The short-term momentum as far as the Hindalco stock goes has definitely softened, given the results, mainly because of the global operations and operational uncertainties, as well as this tariff issue right now. But I don't think there should be too much of a further fall from here. I have a biased view because I am pro-commodity stocks right now, so maybe I'm a little bit biased, but I would say that it may spend some time in the range after the sharp run-up the share has seen, and maybe a little bit more correction could induce more buying at lower levels. That's my personal gut feeling. So not to buy in a hurry, but certainly look at what happens to Novelis, the money which Hindalco pumps in, what happens as far as the actual news comes out on the tariff front. Let's wait for that. So I would say comfortable holding on to it, knowing that the stock could be under pressure for maybe another 5-7% here and then spend some time over here, but not too much perturbed or worried as far as the overall number goes, because I understand Indian operations have done well, and I also understand Novelis was hit more because of the accidents than any other reason.
Got it. Okay, all right. Meribun, since you said you're biased towards some of these commodity stocks, what would be your top buys be? Hindalco, you're sounding reasonably optimistic, though it won't be a runaway winner. But any other names, some niche ideas?
I am very positive on copper as such. Unfortunately, Hindustan Copper, I don't have a great regard for the company as such, but not too many options open for us. As far as Vedanta goes and Hindalco goes, I think that's only 10 to 15% of the revenues come from copper. So I would say Hindalco, Vedanta, even in Hindustan Copper by default are decent bets for me. But the real value stock, if you ask me, with clear disclosure, I'm holding it. That's why honestly the only IPO applied in the last 3 years, and that is Bharat Coking. I think there's a deep value in this particular stock, and closer to its IPO price, if the market gives me an opportunity, I would advise my friends, my relatives to go and buy into the stock, and I personally will buy more into Bharat Coking. So I think there are decent options available for investors to go and buy into commodities. Deep value wise, I would rate Bharat Coking at number 1.
come down a lot. They have to come down by 35% or 40% to get actually to that IPO price, Merbun. But take that that point on board. By the way, guys, you know the Go ahead.
What I meant was the numbers for the quarter never impressed many, and I was hoping that the stock comes down sharply. Unfortunately,
you were hoping?
it never fell that day. It went around 35 and bounced back. I was hoping that you get an opportunity to buy at lower levels if it comes, but unfortunately, it never went below 34, 35, even on the day of the results, which on the surface never looked good to many.
Got it. Okay, all right, Merbun, got that. By the way, guys, T20 World Cup, one of the biggest upsets have taken place. Zimbabwe has beaten Australia by 23 runs.
And yesterday, Afghanistan came very close, right? Very close. So, yeah, I mean,
one of the biggest upsets. I don't remember the last time when, you know, Australia lost to Zimbabwe, but good on Zimbabwe. A good fight out there.
There's an interesting match over the weekend in Sri Lanka. I heard some chatter in the newsroom, plans being made.
That's going to be a big one, Sunday.
Well, yeah, absolutely. But I think the markets have taken a bit of a dip more, right?
Yeah, leg down, but tech is back in the green.
Yeah. Tech is in the green?
Yeah. Many tech stocks in the green. Persistent is in the green. Emphasis is in the green, to just name a few. And I think the tech index has recovered 1,200 points from the low point of the day. So, good one out there.
I was told that some insurance companies, etc., have come in at lower levels and bought in. Perhaps, I don't know if it will show up in any way. I don't think so. It will show up in data in any which way. But yeah, Merbun, any thoughts on this space really from here? I mean, is there you have a strong view on this one? Yeah, go on.
It won't be fair to say that the wolf is at the door as far as tech goes. It won't be fair because if you look at it purely from the angle of cash flow, dividend yield, I think at the present level, not too many complaints. Investors are justifiably worried about earnings compression and PE re-rating. We have to understand that all the frontline stocks, the stocks which are considered to be absolutely dear to investors, they don't look at it at all. The TCS, the Infosys, the Wipros are all down 40, 50, 60% from their highs. This type of prices people have not seen since COVID. The point is, should I go and buy into it? Honestly, not too many reasons. Is there a bounce? There's a bounce. But if we look at the things from the cash flow angle, dividend yield angle, 100% it's a buy. I'm not recommending it because I really don't know what's going to happen. Investors have been selling the software stocks on continued AI disruption, while rotating towards other tech segments, such as, say, memory. Investors with heavy exposure to IT stocks and even mutual funds, which are IT schemes or IT stocks oriented, I think they will have to take a relook and understand as to how many of these companies will be able to adapt itself to the changing environment, which possibly could play itself out over the next 12 to 18 months. There could be other businesses which will be great winners. Some of these companies will be able to adapt itself well, but some of them unfortunately will go down the drain. So it is a very, very, very difficult call if you ask me, and I think investors will have to be very vigilant, very active and trying to identify those type of companies which could not possibly get up again. I hope there are not many, but there could be names which will ultimately benefit because there is something like where you deploy AI, protect your data modes and defend pricing. If the companies can do themselves well, hopefully we will all look at the present day and say, okay, there are quite a few stocks which are great buying opportunities. But personally, I don't have the courage, don't have the guts either to buy them or to recommend them, while stating that from the cash flow angle and dividend yield angle, quite a few of them are looking otherwise attractive now.
Right. Just, a few months back, we were all looking for AI winners. Now we're all looking for AI survivors. But if you look at the mid-cap action, EIL continues to stand out in terms of the price action. Physics Wala, stock that you were telling just yesterday, and the one-way slide that it had, it's rebounded 8.5%, very large volumes. And across the board, these textile stocks, which got hit on account of the India-US trade deal in 2025, are rebounding. Gokuldas 7.5%, KPR Mills up 5%, Vardhaman Textiles up 4%. So that's a pocket where you are seeing some grain. But I think the Vishal Sikka?
Yeah, I mean, I think we should play some sound bites out, right? And I think he's quite a mind. Of course, led Infosys for a couple of years, but has been deeply, deeply embedded in the AI revolution for the last many decades. So I spoke with him earlier today, And I mean, if you had to take, there's no, and I think Dr. Sikka put it saying, well, it's not black and white. So if you're looking for an answer, whether this is completely overblown, so his point was this, that the technology is real, it is disrupting, it is very much here. But the question for investors really is who'll adapt faster, who'll lag behind, and that basically depends on company to company and what kind of work these companies are doing. Repeatable work, at a workflow level, that perhaps gets hit the hardest. If you're one layer below on the application level or even lower, which is more complex to replace, I mean, I guess it's harder in that sense to replace. But his message to IT companies essentially was, don't look back at what's getting disrupted and try and protect that, try and evolve and become innovators to try and meet the needs of the market, which of course now are working with the assumption that AI and generative AI and some of these technologies are here to stay. Some sound bites, listen in.
Things are always slower than we expect. Adoption takes time. Enterprises are very complex. They are like countries. Large companies are like civilizations. Some of them have been around for, hundreds of years, if not decades. So it takes a long time and even in terms of autonomy, there is a lot of still advancements to happen. Similarly, in the services industry, there are dozens of service lines. AI's impact on those service lines is not all uniform. It is not, doesn't happen overnight to all of them. Some systems are much more complex than others. And so the rate of change is always as slow as the slowest pipe in the network. But having said that, I used to say this 10 years ago, 9 years ago, whenever that was. And it is here now. And we have a short window of time in which to sort of transform. I think we have to separate the potential, the promise, if you will, of this disruption from how it impacts in the here and now. In the here and now, you have particular projects that people are executing on, and if a client expects that you now do this project dramatically faster or cheaper or with less people or whatever, then that would impact the here and now. But that is something that takes time. That's what I meant by depending on the service line, depending on the nature of the work, depending on the team that is involved, and things like that. So there is the fear in general of the potential of what this can do to knowledge work. But then there is the actual reality of creating an enterprise-ready offering that uses these new capabilities to deliver those. So there is a gap between them. The productivity, because of using generative AI, can be quite substantial. I have seen examples of 20, 30x productivity gain and things like that. The important thing is that, do we want to keep looking backwards? Do we want to keep looking at tasks that we already do? And do we want to limit ourselves to what we did in the past? Do we want to be afraid of the disruption and automation to the things that we did so far that brought us here? Or do we want to look at the opportunities of what are the new things that I can do with what we have in our hands? And I think, I focus much more on the latter. I have a small company, and life is a lot more interesting when you think about, my God, we have this incredible ability. What can I do with it? And I think when I look at it from that lens, it is incredibly exciting.
Okay, welcome back. There is news on Reliance Industries, which I think I should quickly mention. This is, of course, on all wire agencies. Reuters is reporting, Bloomberg is reporting as well. And the news is that Reliance has won a general authorization from the United States to buy Venezuelan oil. Stocks, I think, come up a little bit from the lows. And this is actually quite positive for RIL. And the reason, of course, is that Venezuelan oil, Venezuelan crude, is basically I mean, there are different types of crude. Saudi Arabia, for example, is light sweet. It's easier to process. But Venezuelan crude is heavy and sour. And, the Jamnagar refinery of Reliance Industries has, the most complex. It's called the Nelson's Index, which basically measures the complexity of the refinery, which how it can basically process very, very heavy types of crude, sour types of crude, which is exactly what Venezuela produces. Back in the day, I think 2010 and before that, actually Reliance at one point, I remember, used to be perhaps one of the largest buyers of Venezuelan crude in terms of private refiners around the world. So they're sort of familiar with it, and now there's authorization coming through as well. So this is positive, because not very many refineries can process that crude the way the Jamnagar refinery can, which essentially means that we'll have to see pricing, etc. If there are some contractual agreements, and those details are not there yet, but this is a license to be able to procure crude from the United States, of course, because of what has happened in Venezuela a couple of months back with regards to U.S. intervention. I mean, the president being deposed, and of course, U.S.-backed person there at the helm of things. So 1420, 1421, stock still down about 1.9% or so. So that's the important bit for RIL. Now, F&O positioning and where do we stand? Nigel is here with details. Nigel.
Well, that's a bit of risk-off playing out in today's trading session. So the India VIX on expected lines, that's perked up a little bit. And the call writers, they are feeling very, very good. Just take a look at the 25,600 call. The premium at the start of today was around 270 rupees. That's come down by a third out there, or less than that, in fact. That one's come down to around 70 rupees. Yeah, so big downtick out there. Aggressive writing is what we're seeing. As is the case with the 25,700 call, premium down to around 40 rupees compares with around 193 rupees that he left up yesterday. And because of this aggressive call writing, we're back down to the lower end of the range. We've come down to around 0.68. I think it's 0.67 now. So the Nifty PCR has come down. It normally bottoms out at around 0.62, 0.63. So I think, we should be bracing for a bit of a bounce on Monday's trading session, given that this technical level is already stretched. And we're at a very, very crucial juncture. The 20 DMA, the 200 DMA, that's the important mark. So 25,250, 25,450 is the important level that we're looking at. Individual stocks, there's some fresh buying being seen on Bajaj Finance. There's some fresh shorting, though, that's been seen on Muthoot Finance, as well as Inox Wind. Good amount of shorts being added out there. And Angel One saw a bit of a bounce, but that one as well has come in for some profit taking. So unbinding oppositions is what you've seen out there. That's about the F&O space, but let's welcome Rahul Vira, the fund manager, equity investments, Nippon India AIF, who joins in. Hi, Rahul. Good afternoon. Good to see you win. What do you do with tech? How much lower can it go? Are you getting constructive? I think Emphasis is one stock that you have in your portfolio. Will you look to add to tech?
Right. So I'll start off with one of the very interesting quotes from Mr. Bill Gates. He said that disruption, right, is always overestimated in the near 2 to 3 year terms, but is underestimated from a 10-year perspective. So we are in that kind of a phase as of now, where very difficult to say what is going to get disrupted and how much is going to disrupt it. Valuation-wise, dividend yield, FCF yield at 4 to 6% for some of these large cap names seems very, very interesting in the sector, no doubt. But incrementally, given the very hazy outlook in a gray area, we would prefer to be on the sidelines as of now. No incremental allocation to IT as of now.
But you own IT in your portfolio. Can you tell us a little bit more about, which stocks do you own? And is there a reason to reduce exposure?
No, we'll continue to maintain the position as of now. And we are slightly tilted towards the BPO space more rather than the pure play IT names in the portfolio.
And for the BPO space, so I presume you mean the kinds of, a Sagility, a FirstSource, eClerx. These are the companies that you're referring to. And yes, to your mind, when you interact with the companies, how is AI disrupting their business model? Is there a risk of margin correction in these models, or revenue growth coming in lower on account of higher deflation?
Right. So see, a couple of things that we understood by doing a lot of channel checks, speaking to a lot of managements. One thing was very clear. Nobody knows the right answer, how things will look after 5 years. From an analyst or a fund management perspective, we need to understand one thing is clear, that the revenue models that we are going to build going forward is going to be disconnected with the headcount. right? So whatever CTC that we're seeing on an average for the freshers, the 3 lakh CTC that we've been hearing for it, the large cap names, we hear that instead of 4 freshers, there's going to be a 1 lateral hire of 12 lakhs instead of 4 3 lakh guys. So the headcount versus the revenue correlation is getting disrupted for sure in the medium term. Now going forward, of course, in the transition phase, which companies will adapt or not, we'll have to wait and watch. But as of now, it's the discussion between the terminal value, the business model is going to be very, very challenging to see 2 years out. So better to wait and watch when the storm is out.
Rahul, hi. How will we know when the storm passes?
The best part would be look at the valuations when FCF yield instead of 4%. We'll have to discount it at the DCF level directly or indirectly and try to see whether we are moving towards 6% yield or not. At 6% yield, probably some of these large cap names will become very, very attractive.
Where are we now for some of the, have you looked at the numbers?
Closer to 4% as of now for the larger names.
I see.
Okay, all right. Rahul, a couple of stocks that you were bullish on, Edelweiss. I think that's the one you briefly mentioned on the last time around, Edelweiss Financial Services. The stock, I think, has done pretty well of late. How much more to go?
We are seeing decent upside in this one. We believe the management is on the right track in terms of the valuation unlocking story over the next 2 years. We continue to maintain the positive stance over the name, but it will be largely an event-driven name. A lot of corporate action has to take value unlocking has to take place over the next couple of quarters.
Any other fresh additions to your portfolio?
We recently added one of the small cap hospitality names. We are very, very bullish across the hospitality space. Even if you see the recent numbers that have come out from the larger guys in the sector, the hotel space, right? Your RevPARs are still trading at high single digit to double digit. Your EBITDA margins are sustaining at 30-35% across the sectors. And we believe the kind of EBITDA growth over the next 3 to 4 years that most of the companies will be doubling their EBITDA over the next 4 to 5 years. And if the valuations are in favor, if your entry point is right, you should definitely look at this space.
I think the stock was Taj GVK, right? That's the one. Got it. Okay. All right. Give us some few more details then with regard to how do you see the telecom space evolve? Bharti Airtel is a stock that you'll have. What about Vodafone Idea? There is suddenly some optimism and the promoter entity has been creeping in. Your view?
Definitely. See, with along with the 2 names that you take, even if the Jio IPO is around the corner now, people are estimating that the ARPUs from here on will incrementally increase very sharply. Street is estimating that. But in terms of our allocation, we prefer to be on the larger names rather than being a little bit more adventurous and taking the small cap names that we discussed.
All right. Rahul, we'll leave the conversation here. Thank you very much for joining in. It's time now for a segment D Street Chatter. Nimesh, we've been waiting by. It's been a bit of a cruel session. IT is recovered, but the rest of the market is still downbeat. What are dealing rooms telling you?
I remind you, while the IT has recovered, the index has recovered 4% from the lows, but the sense is that there is aggressive selling in the IT names, both from FIs and from the DIs as well. My sense is some large domestic insurance companies would have bought and nibbled into some of the IT names in today's market. So that's from a flow perspective. But barring IT, even metal stocks are under pressure today. All the metal stocks are down, and even that's dragged the overall markets down. For a change today, there is a bit of selling in the broader markets as well, and that too from larger institutions. So not only in the large cap names, but there is selling from in the broader markets, the mid and small cap as well, from institutional investors, and some of them are part of my charter list as well. Broadly, I guess for the broader markets, it's a bit of a Friday factor as well, that you're seeing some selling pressure. But even then, the institutional investors are sellers there. Technically, 24,450 is a level to watch on the downside. If that gets taken out, you will see further selling pressure. But now the PCR has moved toward the lower end of the range, so you might see a bit of a pullback. But the street seems to be a bit divided on IT. Clearly, there is selling clearly from both domestic as well as from FI investors, even in today's market.
Nimesh, we're very close to that support level. It's 25,475 on the Nifty, so just about 25 points away from the resistance level, and markets have retreated lower in the last 45 minutes since we started the show. We were well above 25,500, but now taking a leg down. It's more than 1,000-point fall on the sensex. The Nifty decline has now extended to 350 points. What about stocks, Nimesh? What have you picked up in your chatter?
So the first stock on my list is Nazara Tech. It's been consolidating in a very narrow range of late. But I understand the street is anticipating a corporate development, a potential fundraising via preferential issue seems to be on the cards as far as Nazara Tech is concerned. So that's something to track there. The second name is Elin Electronic, a thinly traded stock, but down 6% in today's market, largely because I understand one of the large domestic mutual fund who owns a sizable stake is looking for a block exit in Elin Electronics, and hence you're seeing that pressure on that stock. The third name is OneSource. Again, has seen a big correction post the weak Q3 earnings. There has been selling as well. The promoters did buy a little bit in the last few days, but I understand there was a selling from a domestic mutual fund. That's largely over in yesterday's block. Some institutions have bought, but again, a bit of selling still continues. But at least a large part of the selling from a domestic mutual fund is over in OneSource. The last is Oswald Chemicals. Even if you look at the stock price from the recent peak, it's almost half. And at these levels now, you're seeing selling pressure from larger institutions. I understand a domestic mutual fund is likely to clean out in Oswald as well in the days to come. And hence, even that stock has been under pressure today.
Yeah, interesting names there. Nazara, Elin Electronics, OneSource, Oswald. Nazara, Nimesh, I mean, kind of fell off the radar, right? It used to be news every day with acquisitions after acquisitions.
Yeah.
I think there was some change in shareholding, etc. as well. So what's the shape of things there at Nazara now?
So my sense is there's going to be a preferential issue to non-promoters. So even some large investors are likely to invest in via preferential issue. And most likely this fundraising is going to be a couple of acquisitions as well. It was part of my chat a few weeks back that the company is looking for a couple of acquisitions. So maybe this fundraising would largely be to aid further a couple of acquisitions that they've been eyeing in the domestic market. So that's the broad sense that the fundraising is to non-promoters, and large part of the money could be used for inorganic moves.
I see. Okay. Thank you very much, Nimesh. For that, keep an eye out on all these names as we track them. We'll take a quick commercial break here. We come back with some short-term trading ideas and more market conversation. There is 19 minutes to go for market close.
Welcome back. Markets actually at the low point of the day. So we're going to go into the weekend with the bears feeling on top, actually. The Nifty is down 500 points now. Mitesh Thakur is back with us. Mitesh, just revise the levels on the Nifty and give us those fresh calls.
So Nifty, as I said, below 25, 650, 600 is slightly negative, and we could see further declines. I think I didn't expect the decline to be so severe, but it's playing out. 25,400 is the next pivot, 25,400, 370. And then, you have this day when the trade deal was announced. Before that, we had a high of 25,110. So I think even those levels could be tested. But for the timing, looking at 25,400, 370 as the key level of the index.
Mitesh, what would your trades be?
See, it's an oversold market, but yet I think the directional bias is on the negative side, so we'll take some sell side trades. Vali Energy is a STBT with a stop at 3120 for targets of 3050, 3060, and the other one which I have is Alkem Labs. I think there's a big red candle over there, so that's STBT with a stop at 5425 for targets of 360.
Got it. Okay. All right. Since you mentioned Alkem Labs, let's talk about it. They report their third quarter numbers. Ekta joins us to break it down for us. Ekta.
Thanks for that. Well, yes, Alkem Labs, the revenue is up around 15% this quarter. So and they had the EBITDA margins, which came in at around 25%. The profit was lower because there was a labor cost outflow this quarter. But what really stood out in terms of the geographies was that the India business was up only around 5.5%. The street was anticipating around early double-digit growth, at least for the India business this time. And we had the international business, however, which did well. So that compensated for the India business. But the company, interestingly, and that's possibly one of the reasons why the stock has seen a sharp downtake, is that they have made an acquisition in the medtech space. So Alkem is going to be acquiring majority stake in Occlutech Holding, which is basically a Swiss headquartered global medtech firm. And this is going to be 55% for 180 million euros. It is expected to be the third largest global player in minimally invasive cardiac implants. Now, remember that this particular particular company, however, is loss-making. So 2024 revenue was 397.8 crores, loss was 185.7 crores, and 2025 loss is expected to be around 67.65 crores. So that's possibly one of the reasons why the stock is lower. Separately, the company said that GLP-1 semaglutide launch in March is going to be one of the key things to watch out for and will be a key near-term growth driver.
Okay, all right, Ekta, thanks a lot for explaining that to us. Anand Tandon, market expert, joins us on the show. Hi, Anand. Good afternoon. Good to see you in. Any view on Alkem or any of the pharma stocks?
I think it's generally looking quite good, especially given that you're expecting to see, diabetes medicines going off patent in the near future. And many of the domestic companies have obviously positioned themselves for that. So that would be the next big opportunity besides the regular generic space that they have been operating in. And not a sector that has done exceedingly well in the near past. So therefore, I think there is some valuation comfort as well.
Okay, all right. So pharma is something that you're sounding reasonably optimistic on, Anand. But Anand, otherwise you've been quite, circumspect on some of these broader market stocks. How are you feeling about the mid and the small caps now? Still stay away from them?
Some of them have come down to some reasonable levels. If you look at media, for example, whether it is the distribution side or channels like Z, etc. I mean, the Z5 reported profits for the first time this quarter. And that would mean that subscription revenues have actually picked up enough to be able to start showing up as an EBITDA positive business, while they are still struggling with their overall channel. And there is still, I would argue that the jury is still out on whether people will watch channels anymore, other than through OTT. The thing is that the valuations are not very stretched. I mean, you have roughly 5,000 crores of enterprise value to justify after taking out the cash, or maybe 6,000 crores. And you have a depressed earnings, which is now giving you maybe 11 times. So similarly, if you were to look at the distribution side, or the exhibition side, sorry, not the distribution, the exhibition side, that also, you have a company which is the market leader, which has actually trimmed off, made their costs more variable, have actually started to show some kind of positive cash flow coming through. And all you need is a few large blockbusters like we saw in Durandar, etc., for them to start showing positive numbers. So there are opportunities in small spaces, but by and large, I think, India is a small cap company compared to the rest of the world. And we are operating in a global world today. So if there has to be any change in terms of global outlook, and India were to become a little more favorably positioned in most portfolios, it is the large caps that need to move.
Anand, stay with us. I'm going to take a quick commercial break here. Coming back to you with more questions. Stay with us.
Welcome back. Actually, the Nifty is selling off even more. A few stocks have moved to the low point of the day. BEL intraday chart comes up for you. That's coming for some big profit taking as we speak. Year to date, the stock was up close to 10%. It was a relative outperformer. That's coming for selling. Apollo Hospitals, that's the other one, actually has moved a little bit lower. And there appears there is some kind of selling on select counters. Even Geo Financial has moved lower. And I think Asian Paints is the other one. Thereafter, rallying from around 2,200, I think, to around 2,800. That as well has seen some kind of profit taking. Anand Tandon is still with us. Anand, what about tech? You have seen this play out in the past where there is a scare and some of these tech companies come out stronger. This time around, what's your view? And would you be a buyer after a particular percentage point correction in these stocks?
Maybe after they fall from you. Last year, I had actually, in one of your interviews, said that you should be worried about tech because the manpower requirement will fall off a cliff. You know, people keep worrying whether services industries will remain. Of course, they'll remain. Except that you, instead of having 50,000 people in a company, you should be looking at companies with 500 people. Because that's what you're going to get. So, you know, are you ready to take that kind of risk? Frankly, when companies say that, they cannot be replaced, they are talking to themselves, not to the investors. They are hoping that they will be able to do something where they will not have to worry about where their next revenue is going to come from. So frankly, plain vanilla IT services is not going to survive in the shape and size that we see today. It will have dramatic changes, whether the industry agrees to it or not. Now, as I said, it's not as if everybody will vanish. There will be smaller companies, more specialized companies that will emerge, and some of them will continue to do services. But the days of the monoliths, in my view, are over.
You know, so from an investor's standpoint, I mean, if these companies are able to adapt and productivity increases, I mean, it's a different equation, right? So you think there's blood in the water, but there will be opportunities along the way as well, right, Anand?
Yes, there will be opportunities, but see, what is happening is that, you know, AI, for example, is driven by 200-300 people around the world. I don't think even the large companies know exactly how the next step is going to emerge because it is coming out of the labs and the researchers. Now, obviously, you can hype it up and say that everything will change tomorrow, but it doesn't have to. There is enough evidence to show that new hiring is going to be a problem. Just take the Indian companies itself. This year, the total net hiring is negative from the top companies in the country. And I keep suggesting that people should be worried about what that does to overall consumption demand, because if you don't have high-paid jobs coming through, and this is not only in tech alone, anecdotally, you can hear that happening in almost all high-paid services industries like legal, for example. There are legal AIs available which are preventing new interns from being hired in companies because that job can be done. There are research people who can be replaced early research people, because without the experience, the AI does much more on its own. So the point is that you are going to see a major issue with what you're going to do with the already surplus trained manpower. Forget the untrained ones that you're talking about. And that is not a problem that's going to go away. So like I said, I have been somewhat bearish, perhaps prematurely, on what it will do to consumption demand domestically. But I think, it is only a matter of time before it starts to play through.
Got it. Okay, all right. Thanks a lot, Anand, for that. By the way, I think we should pull up the intraday chart of Oro Pharma. That stock has seen a sharp recovery from the low point of the day. So big move is what we're seeing on that name, ending more or less flattish after being down close to 3%. What did well in today's trading session? Bajaj Finance, showing who's the boss. That one has bounced back after going through a time and a price-wise correction. Eicher Motors as well was up close to 1.5%. That's where the good news ends. Hindalco is down. The tariffs could come off. Midwest premiums will narrow down. Scrap spreads will come under pressure. That's the fear. Stock down 6%. HUL, profit taking yet again. The stock is down after the results. In fact, the stock has seen a correction of around 7%. Eternal, after having a run from 250 to 300 rupees, that one as well has seen some selling. And Adani Enterprises, another stock that did see some profit taking. Coal India, numbers a little bit disappointing. Unsure what's going to happen going ahead, given that captive coal blocks are ramping up as well. So that stock is down close to around 2.5% in trade today. the tech index, that actually recovered substantially from the lows of the day. So the Nifty IT index goes home with a cut of around 1.4%. You'll say, what's the recovery in that? Well, it was down 4% earlier. And the index that actually broke the back of the market was the Nifty Bank. That one, in fact, goes home with a cut of around 600 points. Routine profit taking, one could say, because, we have seen already a big run. The good news is it at least defended some of those crucial levels on the downside. So net, disappointing trading session. The bears going into the weekend, feeling on top. Can the bulls fight back? That's something that we'll be tracking next week. I'll tell you what. Slip into a short break, come back. Editors Roundtable on the other side of the short break. Stay tuned.